blocker, and UBIT. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's podcast, I want to discuss using a C-Corp blocker, domestic or foreign, and how that could potentially block the application of the Unrelated Business Income Tax on your self-directed IRA investment. So let's get started. Firstly, what is a C-Corp blocker? Well, C-Corp is a corporation that has two layers of tax. There's a corporate layer and a shareholder level. And if you compare that to an LLC, an LLC is a pass-through entity. It has one layer of tax, a member, a shareholder level. There's no entity level tax on an LLC. So if a corporation makes $100, there's a 21% flat corporate tax rate, which would leave the corporation with $79. And then a dividend from the C-Corp to the shareholders would be subject to a dividend tax of, let's say, 15 or so percent. So that's two layers of tax. If the LLC made $100, there'd be no entity level tax, and the member would pay tax at his or her ordinary income tax rate. Okay, so that's why for the last 20 or so years, most small businesses, most funds are set up as LLC pass-through investors. Now, let's move into the IRA 401k world. In most cases, when a retirement account makes an investment passively and generates interest, dividends, royalties, rental income, capital gains, it's all tax deferred or tax-free in the case of a Roth IRA. It's one of the main advantages of using a retirement account to make an investment is that it's generally tax deferred or tax-free in the case of a Roth. However, in three instances, the ugly four-letter word called the UBIT or UBTI, also known as Unrelated Business Income Tax, will apply in those three specific instances, which are: one, retirement account uses a loan to buy stocks. And in all cases, a loan involving a retirement account must be non-recourse. Non-recourse is a loan not personally guaranteed by the IRA or retirement account holder. Why? 4975C is clear that you cannot personally guarantee an obligation of your IRA. So therefore, that's why all retirement account connected loans must be non-recourse. Two, use a non-recourse loan to buy real estate. There is an exception for solo 401ks in certain circumstances where the UBIT tax for using the non-recourse loan to buy real estate will not apply to 401ks. And then thirdly, which apply to IRAs and 401ks like margin and stock, is when a retirement account, IRA or 401k invests in an active trader business, like a restaurant, through a pass-through entity like an LLC. Now, there's an exception for corporations, right? If you own Tesla, Apple, IBM, Ford, Netflix, right? Peloton, maybe you don't want it, but if you do, and it's a corporation, as you know, you don't have to pay UBIT, right? That's why most retirement account holders never heard of UBIT. Because when you buy mutual funds or ETFs or publicly traded securities, there's corporations in almost all instances, and they block the application of the UBTI tax. So that brings us to the blocker strategy. In most cases, you don't need a blocker. When you need blockers are if you're going to trigger the UBIT tax, right? If a retirement account is going to trigger UBIT, again, margin to buy stock, non-recourse loan to buy real estate, or invest in an active trader business. So hedge funds, private equity funds, venture capital funds, those real estate funds use leverage, right? Those are the four main instances where a blocker will be set up. Now, if you're an individual investor, you may set up a C-Corp blocker. If you're investing in a private business, that's a pass-through entity, like your friend's ice cream shop or your friend's manufacturing entity. But if you're investing in funds, generally private equity, venture capital, hedge fund, real estate fund, those are the situations you'll want to do a blocker. Why? The highest maximum UBIT tax rate is 37%. And that gets triggered at a very low rate, around 15,000 or so. Whereas the corporate tax rate is 21%. So using the blocker, you're not eliminating the UBIT tax. It's not going from 37 to 0 in most cases. It's going to 37 to 21%. So you got to run the numbers. You know, I was speaking to a client Friday and we're going through some scenarios. Like sometimes it's just a numbers game. So for example, you're investing in your friend's business. He's going to generate maybe $1,000, $2,000 in net income a year. Okay. The C-Corp block blocker will force you to pay 21% versus 37%. Okay, maybe it's a little bit of saving, not material. There's costs involved in setting up the C-Corp. What about loan? Let's say you're using an IRA to buy real estate and you're using 20% leverage, 30% leverage. And maybe that UBTI income amount, remember the UBTI tax only applies to the leverage portion of the income. So if you're using 20% leverage and 80% cash, then about 20% of the net income from that investment will be allocated or subject to UBIT. So maybe that's only $6,000. And if you use a C-Corp blocker, it's 21% on all the income, not just 20%, right? C-Corp, you pay the 21% on all the income. So maybe you're better off paying the UBIT tax of 37% on 20% of the income versus 100% of the income subject to 21%. I run the numbers, no right or wrong. And what about foreign blockers? And I'm not going to spend a lot of time on this because this is super complicated. Okay. Most big hedge funds, private equity funds, real estate funds, venture capital funds that want foreign investors, people from Saudi Arabia or Europe or China, are going to need to set up a foreign blocker, let's say in Cayman or BVI. Why? Because foreign people don't want to file U.S. tax returns and don't want to be slapped with 30% withholding. So they're going to set up, in a lot of cases, a foreign blocker in a jurisdiction with no tax. Some cases, they'll set up a blocker in a jurisdiction that has a really good tax treaty with the United States to reduce the dividend tax, maybe. But it depends on the investment. A lot of the real estate hedge funds, private equity funds that I deal with set up Cayman or BVI blocker corp. So that means someone from China could use that entity, but also an IRA could then send the money to the foreign blocker. The foreign blocker would then sometimes invest in a U.S. corp, and the U.S. corp will invest in the fund. They put in the U.S. corp there so the foreign people don't have to file, we got K1s, tax filings with the U.S. Entity because they don't want to deem to be effectively connected income. Right? If a foreign company owns U.S. LLC that owns real estate, that's deemed effectively connected income, which can trigger all kinds of tax issues. So if you have a U.S. blocker, the U.S. corp would file the return and not the foreign persons would have to potentially disclose their ownership in that fund. So usually you go IRA, foreign blocker, Cayman, or BVI, foreign blocker, U.S. corp into the fund. The idea, obviously, in private equity venture capital is when you sell the business, the sale of the Cayman shares or the sale of the BVI corporation would not be subject to withholding tax. And since there's no tax in the Caymans and it's capital gain transaction, there's no tax in the US either. That's the way you would do it. Dividends, a little more complicated. There's something called dividend received deductions where you can potentially reduce the taxation of 100% on the dividend received deduction from the US corp to the foreign corp. Not going to get into that. That's like hardcore US international taxation. You're going to have to deal with a big firm for that. But don't worry. The funds you're investing in will be able to assist you. What about real estate? Real estate's a little complicated because there's something called FIRPTA. When a foreign person or foreign company owns an interest in U.S. real estate, there's potentially a 10% gross withholding tax. That's known as FIRPTA. There's ways to get around it when you have a foreign corp that generally is in the BVI. And again, I don't want to kind of get into this, but it's through section 7874. Just if you're listening, there's a way if you start with Cayman that owns a U.S. corp that owns real estate, you can sell the Cayman stock to BVI and then sell the BVI shares and not pay any FIRPTA tax or potentially any U.S. tax for a retirement account holder. So there are strategies. A lot of these funds will help you or at least put you in touch with the right people. Again, most of these funds will need you to be a credit investor, have minimum investments of $250,000 plus. So you're not talking about small investments. And in those cases, foreign blockers may make sense. In most cases, they'll have foreign blocker structures set up already. So they'll be able to explain to you how it works. Why? Because they want foreign money. They want pension money. It's a lot of this $30 trillion of retirement money, a lot of foreign money out there. And foreigners don't want to have anything to do with the United States from a tax standpoint. So they don't want the income effectively connected income, ECI. So they want blockers to block any tax filings. And then they'll force the U.S. government to go after their income in BVI, which is almost impossible because the U.S. government will likely not know it's even there. So That's kind of the play. Most of my clients will do US blockers. They'll reduce the 37 to 21%, and they're cool with that. So the more sophisticated clients of mine will use Cayman or BVI blockers, BVI for real estate, Cayman for private equity, venture capital, hedge funds. Most of the time, they're not going to ask you to set one up yourself. They'll do it for you because they're going to want to raise tens, if not hundreds of millions from foreigners and pension funds. So it will be set up already. So you're not going to have to set up, a foreign blocker to invest in a really big fund. It's a small fund. You may have to. And again, if you're doing like your own individual deal in your friend's business, you're probably not going to need Cayman. You probably just do US and reduce 37 to 21%. You're probably cool with that. But again, if you want to go to zero, you potentially could do a Cayman company. And especially if your play is going to be a sale, then the sale of the Cayman stock, assuming a buyer wants to buy the Cayman stock, would not be subject to UBIT tax. As a capital gains structure. So anytime you deal with foreign entities, it's complex. There's the U.S. tax regime is very, very complicated when it comes to foreign taxation. Trust me, I practiced tax law for 9 years at big firms, and I took in law school, and when I was studying, got an LLM in taxation, I took a number of foreign taxation classes, and they're the most complicated because there's all kinds of branch profit tax, portfolio interest exceptions, subpart F, PFICs, CFCs. There's a million rules that if you're not an expert, you're going to get tripped up. So if you are looking to do a Cayman or a BVI Corp, talk to the fund you're investing in and get a tax attorney or a CPA, because you can't do it on your own. Even me, I haven't been practicing law for a number of years. If I had to do one of these structures my own, I would hire a tax lawyer to help me, because the laws changed. Some of the rules changed in 2017 with the Jobs Act, and you just don't want to mess around with this stuff because it's super complicated. But there are right ways to do it, and the tax attorneys that are practicing are really good in this area and know the rules, and they can help you structure something to minimize taxation, just like the BVI trick when you sell Cayman stock to a BVI company and get around FIRPTA. And there's also ways under 7874 for Cayman Island corps to essentially avoid dividends through dividend receipt deductions. And then there's portfolio interest exception for interest exceptions, avoiding withholding tax. Because the key is, hey, if you're doing a foreign blocker, you don't want to pay any tax. You don't want 30% withholding. That's the worst. You don't want to pay FIRPTA tax, 10% on real estate. And you don't want to pay U.S. income tax, UBIT tax, 37%. So you're looking at ways to either do 21% of a C-Corp blocker or less. The goal is zero. So the only way you would use a Cayman or BVI is if you can reduce the 21% to zero. In some cases, depending on the ultimate investment, you can do it, right? If it's dividends, interest, capital gains, depending on how the structure is, you potentially reduce it to zero. In some cases, it may not be worth the cost. It can generally cost you $10K or so to set up, and 5 to 10 grand annually to stay in good standing, because you need board minutes, you need local agents, and the law firms take advantage of that. So sometimes it just doesn't make sense, right? If you're going to generate like $8,000 of income, you don't want to pay $6,000 to keep a C-Corp blocker in Cayman. One last thing I want to mention: if you have less than $1,000 in net income, subject to UBIT, you don't have to file a 990T. The 990T is the tax return. It's filed by the retirement account, not you personally. It's due April 15th by the retirement account, not you. Under $1,000 in net income, subject to UBIT, you don't have to file. You also can take advantage of losses. If you're doing real estate funds or other types of funds and you have losses, you can use those losses to offset future UBIT in future years. So that's a positive as well. Call us if you're a client of IRA Financial. We have a lot of expertise in the area. We have accountants, tax attorneys that can assist. But I'm just saying, if you want to kind of maneuver around the foreign blocker entity structures, get help, because it's super complicated. And talk to the fund you're investing in. I wouldn't probably do it for just a one-off individual investment into the U.S., like a standalone business. I'd probably just do a C-Corp blocker and reduce 37 to 21. Because doing a foreign blocker may not help because it's a small business. No one's going to want to buy your Cayman stock. So it may not help. Whereas if you're dealing with private equity or hedge funds, and there's capital gain sales, there's a lot more flexibility in getting that income to the foreign blocker without any withholding tax, especially on capital gain transactions, which is what hedge funds, private equity do. The real estate's more complicated because of FIRPTA. So all in all, foreign blockers are doable. They're great, but you need to work with experts. C-Corp blocker is a lot easier, but you're really going to reduce the tax just to 21. It's not going to go to 0. So hope it helps. I'm going to do a lot more info on this. I got a lot of questions on C-Corp blockers, and there's really not a lot out there. I feel like the tax attorneys keep all the info to themselves. So I'm going to try to share the love with you guys, and I don't want to try to keep it simple. It's overly complex. I don't want to do that because what's the point? You're just going to get more confused. But U.S. blockers could help. Not going to reduce to 0, reduce to 21%. Foreign blockers could reduce the UBIT tax to 0, but based off what the investment is, private equity, hedge fund versus real estate fund, and then Cayman versus BVI, and then how is the U.S. operation set up? Are you going to need another blocker in the U.S., especially if it's dividends, to get a dividend received deduction, if it's real estate, or if it's just a private equity fund? Good news is a lot of the bigger funds will have all this in place for you, so you're not going to have to even figure it out. So thank you for listening. If you're watching on YouTube, thank you very much. Don't forget to subscribe. Great YouTube channel. This is a weekly podcast that drops every Tuesday, so definitely look out for it. Appreciate you guys spending some time with me. I hope it didn't get too complicated. I tried to explain what a blocker is, what a C-Corp is, U.S. versus foreign taxes, but it's a super, super complicated topic. Trust me. Anytime I got an international tax assignment when I was a lawyer, I liked it because it's challenging, but I knew I was going to stay late and have to do tons of research because it's so damn complicated. So anyways, I did my best to keep it as simple as I could. Hope you guys found it interesting and helpful. And if you didn't, my bad. I'll do better next time. Otherwise, have a great rest of your day and take care.